Listen, there is a recession playbook that works in every cycle, and it has nothing to do with your feelings, your politics, or your predictions. It's about survival first, then return. I'm not here to comfort you. I'm here to protect capital. And I'm telling you, with the same calm certainty I've had before every major drawdown I've lived through, most portfolios are positioned for the last environment, not the next one. When headlines start screaming soft landing and resilient consumer, that is usually the exact moment investors quietly stop checking their downside exposure. They start confusing a delayed recession with a canceled recession, and that's when the market finds the weak hands. A recession doesn't announce itself with a bell. It arrives through credit. It arrives through layoffs and margin compression. It arrives when refinancing turns from routine into triage. And by the time the official data confirms it, the repricing has already happened. Now, the title of this commentary is simple. Kevin O'Leary says, buy these 3 investments now to survive the next recession. Good. I'm going to translate that into something an adult investor can actually use, because buy these 3 investments is not a shopping list. It's a framework. If you treat it like a list, you'll buy the right thing at the wrong price, in the wrong size, for the wrong reason, and you'll still lose money. Here's the philosophical problem most investors have. They think surviving a recession means finding something that goes up while everything else goes down. That's not survival. That's a fantasy. Real survival is staying liquid enough to avoid forced selling, staying paid enough to avoid lifestyle liquidation, and staying disciplined enough to buy when valuations finally become rational again. If you want a recession-proof portfolio, you don't need heroic assets. You need a portfolio that respects 3 realities. First, recessions are credit events. Second, central banks react late and then overcorrect. Third, when liquidity dries up, the only thing that matters is cash flow and balance sheet strength. That's it. Everything else is noise. I've watched people lose decades of compounding because they were right about the economy and wrong about the structure of their portfolio. I've seen investors with high incomes and good businesses get wiped out because they were forced sellers at the bottom, not because they were stupid, because they were overexposed to one regime, cheap money. And cheap money is not a permanent feature of markets. It's a phase, a long phase sometimes, but still a phase. So when someone like Kevin O'Leary talks about recession survival, you should assume he's thinking the way capital allocators think. Protect principal, generate cash flow, and keep optionality. That's the entire game. And if you want the 3 investments, I'll give them to you the right way, by category, by purpose, and by conditions. Investment number 1, short duration, high quality yield, not cash under the mattress, not money market because it feels safe. I'm talking about owning the front end of the curve when it pays you properly and when it gives you something most investors don't have, optionality. In a recession, the highest return you can earn is often the return on flexibility. When growth slows, central banks eventually cut. When they cut, short-term yields fall. That means the window where you can earn respectable yield with minimal duration risk does not stay open forever. So the rule is simple. If you can get paid a real yield, after inflation expectations, after taxes, after your own opportunity cost, without locking yourself into long duration, you take it. Why? Because recessions are when assets go on sale. The best buyers are the ones with liquid purchasing power when everyone else is trapped. This is where people get it wrong. They obsess over the yield and ignore the reinvestment risk. If you buy long bonds because you want to lock in a rate, you're making a duration bet. Sometimes it works, but in the wrong recession, long duration gets punished too, especially if inflation remains sticky or the term premium rises. Short duration is not a forecast. It's a posture. It keeps your capital intact while you wait for forced sellers to create discounts. And you need to understand something. The market doesn't reward courage. It rewards timing and liquidity. Courage without liquidity is how people go broke. If you are holding speculative equities, unprofitable growth, or levered real estate into a recession, short duration yield is not your investment. It is your life raft. And a life raft is not supposed to be exciting. Investment number 2. Dividend-paying equities with pricing power and balance sheet discipline. Not high yield as a blind screen. Not dividend aristocrat as a religion. I'm talking about companies that can maintain the dividend through a credit contraction because they have 3 things. They sell necessities or entrenched services. They can raise prices without losing the customer. They are not dependent on capital markets to survive. In every recession, the market relearns the same lesson. Revenue is not the same as cash flow, and cash flow is not the same as distributable cash. Dividends are not magic. They are a signal when they are real. A healthy dividend says management is confident in the stability of cash flows and the durability of the business model, but only if the dividend is funded by free cash flow, not by debt and not by financial engineering. The reason dividend-focused quality works in recessions is not because dividends prevent drawdowns. They don't. It's because dividends change your behavior. When you get paid, you're less likely to panic sell. When you get paid, you can rebalance. When you get paid, you can buy more when prices are irrational. This is the quiet advantage retail investors refuse to acknowledge. Income makes you patient. In recessions, the highest cost mistake is impatience. Now, I'm going to be specific about what pricing power means because people throw that phrase around like a badge. Pricing power means the customer complains but pays anyway. It means the product is embedded in a budget that is non-discretionary, or the service is too critical to cut, or the switching cost is too high. And in a recession, pricing power matters because volume slows. When volume slows, margins come under pressure. When margins compress, highly levered business models break. When the business model breaks, the dividend gets cut. And when the dividend gets cut, the stock reprices violently because the investor base changes overnight. So if you're going to own dividend equities into a recession, you own them like a lender. You check interest coverage, you check maturity walls, you check payout ratios. You check whether management has a history of respecting shareholders, not just marketing to them. That is recession investing. It is not romantic. Investment number 3, gold. Owned as insurance, not as a prophecy. Gold is not there to make you rich. It's there to keep you sober. Every serious investor eventually learns the same thing. Your biggest risk is not the recession itself. It's the policy response. Recessions break things. When things break, governments and central banks intervene. That intervention changes the value of money, the cost of capital, and the credibility of financial promises. Gold does not produce cash flow. That's its weakness. Gold is not someone else's liability. That's its strength. In the next recession, the debate will not be, will they cut? Of course they'll cut, eventually. The debate will be, can they cut aggressively without reigniting inflation expectations, without spiking the currency risk premium, and without losing control of longer-term rates? If they can, risk assets recover quickly. If they can't, you get a more complicated regime. Weaker growth, political pressure, and persistent inflation risks. Gold is a hedge against that second regime. And if you've never lived through a period where policymakers are trapped, where inflation won't die, growth is slowing, and debt servicing costs are politically intolerable, then you don't understand why a small allocation to monetary insurance is rational. Not emotional, rational. Now let me connect these 3 investments to the actual mechanics of a recession. A recession is a coordinated slowdown in economic activity. But markets don't trade GDP. They trade cash flows discounted by rates and risk premia. The recession trade is usually driven by 4 forces. 1, labor softens. Unemployment rises with a lag. Consumers pull back. Delinquencies rise. The weakest household balance sheets crack first. That hits discretionary spending, then housing-related spending, then broader services. The impact is not uniform, but it rhymes every time. 2, corporate margins compress. When demand slows, companies lose operating leverage. Fixed costs don't fall as fast as revenue. Inventories build, promotions increase, earnings estimates come down, slowly at first, then all at once. 3, credit tightens. Banks become defensive. Underwriting standards rise, spreads widen. Refinancing becomes expensive or unavailable. This is where good companies become bad stocks because the market begins pricing the probability of dilution, covenant issues, or insolvency, not the brand. 4, the policy response arrives late. Central banks cut after the damage shows up. Markets front-run the cuts, then argue about whether cuts are bullish or bearish. Cuts are bullish for duration and bearish for the economy at the same time. If you can't hold 2 truths at once, you will trade poorly. So where do our 3 investments fit? Short duration yield fits because it benefits from higher short rates now and preserves optionality later. It's a bridge between regimes. Dividend quality fits because in a world where earnings are uncertain, getting paid matters. The market will still punish multiples, but it will reward durability. Gold fits because the policy response can create second-order risks. Currency debasement, negative real rates, financial repression, especially when public debt levels make austerity politically impossible. That's the framework. Now, I want to neutralize the most common counterarguments because I've heard them for decades and they never die. First objection, if a recession is coming, I should just go to cash. No, cash is a tool, not a strategy. Cash can protect you from volatility, but it also exposes you to policy risk and purchasing power risk. The point is not to hide in cash indefinitely. The point is to park capital in instruments that pay you while you wait, and that can be redeployed without penalty. Second objection. Dividend stocks drop too, so what's the point? Correct, they do. The point is not that they don't drop. The point is that high-quality dividend equities tend to have less fundamental impairment. They recover because the business survives. And the income stream allows you to hold through the drawdown without becoming a forced seller. If you don't value that, you've never been through a real liquidity squeeze. Third objection, gold is useless. It doesn't yield anything. Also correct and completely irrelevant. Insurance has a negative carry too. You still buy it because you don't want to be wiped out by tail risk. Gold is not for your return. It's for the part of your portfolio that must not fail when confidence fails. Now, a forward-looking warning, and I'll keep it controlled. The next recession, whenever it arrives, is not going to punish everyone equally. It will punish leverage, weak cash flows, and narratives. It will punish any business model that depends on refinancing every couple of years at friendly rates. It will punish households and investors who structured their lives around permanently low interest rates. And it will punish portfolios that confuse diversification with owning many versions of the same risk. If you ignore what I'm saying and you stay overweight speculative growth, long duration assets, and levered real estate without cash reserves, you're not making an investment decision. You're making a bet that the next downturn will be mild, that credit will stay open, and that you'll have time to react. And time is the one thing recessions never give you. The people who do well in recessions don't predict perfectly. They position early, they stay liquid, and they buy when everyone else is negotiating with reality. That's what these three investments are really about. 1. Liquid yield, short duration, so you can move. 2. Durable cash flow, so you can endure. 3. Monetary insurance, so you're not dependent on policy credibility. If that's your posture, you don't need to panic. You don't need to chase. You just need to execute. If you want more of this kind of clarity, calm analysis that prioritizes capital preservation over comfort, subscribe. And watch the next commentary because I'm going to lay out the assets that look safe right now, but historically break first when credit tightens. That's where the real losses come from.